Rio Tinto is an Australian-British, the world's third largest transnational mining and smelting company. It consists of two operating companies, Rio Tinto Limited and Rio Tinto plc, referred to collectively as Rio Tinto Group. The company has a very long history. It was founded in 1873 and it named after the river in Spain. Rio Tinto operates on 6 continents, but it is mainly concentrated in Australia and Canada. The company pays dividend twice a year. In 2021, the company paid $9.63 dividends per share. The forward dividend is expected to be $8.34. The stock price is $57 as for the time I'm making this video. Such a high dividend yield rose due to the fact that the company is valued very cheaply. And there is a reason why it's cheap. The company's revenue and net profit are expected to decline in the next 5 or even 10 years due to declining metal prices. Rio Tinto's main business is the production of raw materials such as iron ore, aluminium, diamonds, uranium, copper, and other industrial metals and minerals. Revenue and net profit of the company are highly dependent on the metal prices. There is a clear correlation between London Metal Exchange Index and the price of Rio stocks. 59.2% of the company's revenue in 2021 was iron ore. The company produced 322 million tons. Aluminium made up about 19% of the company's revenue. The company produced 3.2 million tons. Copper made up 11.7% of the company's revenue, 494 kilotons of mined copper and 202 kilotons of refined copper. The company expects to see slightly higher numbers in 2022, but the prices of all these metals are expected to decline in the next few years. And predictions don't always come true, of course, but now there are fundamental reasons for the price drop. I don't see the point to analyze forecasts for every single metal that the company produces because there are very many of them, while the 3 main ones make up about 90% of the company's revenue. In March, Fitch Solutions published these price assumptions. Fitch Solutions expects that copper prices to decline from 9,500 per ton in 2022 to 8,500 in 2023, 7,500 in 2024 and 2025, and to 7,000 in the long run. Aluminium prices are expected to decline from $2,950 per ton in 2022 to 2,600 in 2023, 2,500 in 2024, 2,250 in 2025, and 2,000 in the long run. The agency published these assumptions in March, and the prices of these metals already dropped to the levels that the agency expected to see in 2024. The market reacted very sharply to the risks of a recession, tightening of monetary policy, and the rise of the dollar index. Iron ore prices are expected to decline from $110 per ton in 2022 to $85 per ton in 2023, $75 in 2024, $70 in 2025, and $70 in the long term. It will be driven by stronger supply with a combination of weaker demand growth. Fitch Solutions predicted iron ore output surge until 2026. The global mine output growth is projected to average at 2.7% over the period from 2022 to 2026. This will lead to an increase in world iron ore production by 361.7 million tons. This compares with negative growth of 1.3% over the previous 5-year period. The growth will be driven by Brazil and Australia, since Vale in Brazil has made aggressive expansion commitments, and Rio Tinto, BHP Billiton, Fortescue in Australia plan to use these high profits they have right now to increase production too. Rio Tinto ended 2021 with an excellent balance sheet and $50 billion cash and cash equivalents. Beyond 2026, Fitch Solutions expects lower prices to eventually slow production growth rates, and it forecasts early iron ore production growth rate average of 1.1% over 2026 to 2030. The major companies will also continue to decrease costs and focus on higher quality ores to improve margins. On average, the cost of producing iron ore in Australia is $30 per ton, compared with between $40 and $50 per ton in West Africa and $90 in China. As for aluminium, the prices are expected to remain high this year and the next year, as some supply disruptions will persist, which was the result of historically low stocks of the metal. In the long term, aluminium prices will be supported by stable demand from electric vehicle manufacturers. This metal is used to bring electric vehicles' weights down, and Fitch Solutions expects that the use of aluminium in structural and body components of electric vehicles will become more frequent. Global aluminium consumption is projected to grow from 65.87 million tons in 2022 to 78.4 million tons in 2029. There is also rising demand for low-carbon aluminium that presents a future risk to aluminium pricing. ESG, environmental, social and governance, becomes the core strategy for companies worldwide, but so far there has not been enough demand for a significant or reliable green premium to materialize, but as carbon neutrality targets approach in the coming decades, the market may find it difficult to price the greener metal. So despite the fact that the demand for aluminium will remain strong, there are major risks for the pricing. In March this year, when the price of aluminium reached $3,000, the situation in the aluminium market remained at a giant bubble. Now the situation begins to normalize. Okay, what about copper? Copper prices, by the way, are considered one of the indicators of the state of the global economy. Due to its wide application in a wide variety of sectors, if copper is in short supply, then the economy is growing, otherwise not. Since April, copper prices have fallen sharply. The recession won't last forever, but it won't end quickly either. Over the long term to 2030, the copper market is forecasted to remain in deficit as consumption continues to outpace supply, driving prices higher amid the green transition. Copper is also used in electric vehicles. According to the Copper Alliance, plug-in hybrid electric vehicles contain about 60 kilograms of copper metal, and battery electric vehicles about 83 kilograms. This is much more copper than it is needed in the production of conventional cars, which is between 8 and 22 kilograms. Finally, I want to say that forecasts have contradictory properties sometimes. For example, in the end of 2020, many banks, analysts, agencies have predicted that oil prices will remain at $40-50 in 2021 due to the fact that demand for oil will not recover much. However, due to negative expectations, underinvestment led to the inability to meet the increased demand. So the price of oil has skyrocketed. Could the same situation develop in a few years in the copper market, for example? It certainly can. That's all for today. While I was making this video, I got the urge to do some research and compare old forecasts from banks, analysts, agencies, companies, investment houses to find out how accurate these forecasts were. Perhaps this will be one of my next videos. Thank you for listening.